Hey, welcome. Today we're going to dive into a trading concept that kind of flips the whole script. I mean, instead of trying to trade against the biggest players in the market, what if you could actually trade like them? We're talking about the whales. The big institutions moving trillions of dollars every single day, and we're going to try and break down their playbook.
And this quote right here, it really gets to the heart of what's called the smart money concept, or SMC. It basically paints this picture of the market as a game, right? A game between these massive institutions and individual retail traders like you and me. The whole theory is that the goal isn't to try and beat them at your game, it's to understand and play by the rules of their game.
And that's the million-dollar question, isn't it? So many traders, they learn all the classic patterns, they follow the textbook rules about support and resistance, they draw their trend lines, and they still find themselves on the wrong side of a trade, over and over again. This whole explainer is going to dig into one theory that tries to answer why that happens so often.
So how are we going to unpack all this? Well, here's the game plan. We've already touched on this idea of retail versus the big institutions. Next, we're going to learn the lingo of this strategy. After that, we'll dive into how to spot the real trend, what makes a market move valid, and then finally, we'll put it all together to figure out how to spot when a trend is going to keep going or when it's about to reverse. Okay, so before we can even start to analyze a chart like an institution, we got to speak their language. You'll notice this whole strategy has its own vocabulary, its own lingo, full of acronyms. But don't worry, they're really just shorthand for key things happening in the market. Let's quickly go over the most important ones. So at the top, of course, you've got SMC itself, the smart money concept. And just to put it simply, the whole point here is to look at charts in a way that lines up your trades with what the big institutional players are doing, instead of accidentally trading against their massive momentum. Next up, we have BOSS, which stands for break of structure. This one is super important. Think of it as a signal that the trend is continuing. So if a market is trending up and it breaks through a previous high point, that's a BOSS. It's just confirming, yep, this uptrend is still going strong. Same thing in a downtrend when it breaks a previous low.
Now, its counterpart is choach, or change of character. And this is your first major red flag. Let's say the market's been in a beautiful uptrend, making higher highs. A choach is the very first time it fails to do that, and instead breaks a recent low. It's the market changing its tune, giving you a hint that a reversal might be just around the corner.
All right, and the last one for our lingo lesson is OB, or order block. An order block is just a key price zone. It's that last down candle right before a huge bullish move, or the last up candle right before a massive drop. Traders who use SMC watch these zones like a hawk, because the theory is that institutions have huge piles of orders just sitting there waiting.
Okay, so now that we've got the key terms down, let's see how they all fit together. We're moving on to the idea of a trend. And I know, that sounds super basic, right? But this whole methodology argues that most retail traders are looking at it completely wrong. And the source material really leans into this. We've all heard the saying that trend is your friend, but come on, if it were that simple, why do so many traders get caught in false moves? Well, according to this concept, the answer is all about telling the difference between the market's main direction and all the little bits of noise happening inside of it. And this image here shows you exactly what I mean. See that black line? That's the major structure, the big overarching downtrend. But inside that huge move down, you see all those smaller little swings up and down? That's the minor structure. And according to this theory, that is exactly where traders get trapped, because they mistake a small pullback for a whole new uptrend.
This brings us to what is, honestly, the absolute heart of this whole strategy. How do you tell the difference between a real, significant move in the market and just, well, market noise? In other words, how do you know if a high or a low on the chart is actually important enough to pay attention to?
Okay, listen up, because this is the crucial rule, and it feels a little backwards at first. To confirm that a new swing low is valid, it's not enough for the price to just go down and then pop back up. For it to count, that pop back up has to be strong enough to break the most recent minor high that was made on the way down. Let's just look at a chart example. It'll make more sense.
And this chart, it lays it all out for us. Look at the points that are labeled valid swing low. Notice that every single one is only confirmed after the price moves back up and breaks that previous little peak, that minor high. Any lows that don't do that, they're considered insignificant, just noise inside of a larger move down.
And you guessed it, the exact same logic is true for an uptrend, just flipped upside down. A high point doesn't get confirmed as a valid swing high until the price pulls back down far enough to break a recent minor low. This rule just makes sure that the pullback has some real substance to it before you start treating that previous high as a major point on your chart.
Okay, so we've learned how to spot the real swing points. Now for the fun part. How does this actually help us figure out if a trend is going to keep rolling or if it's about to turn around? This is where those terms we defined earlier, BOS and CHOH, really come into play.
So let's break this down, nice and simple. A break of structure, or BOS, is your green light. It signals the trend is continuing. It happens when the price breaks a confirmed, major swing point in the same direction as the trend. Now, a change of character, or CHOCH, that's your warning signal. It's the very first time the price breaks a valid swing point against the current trend.
Now check out this chart of a nice clean uptrend. Every time the market breaks through one of those confirmed major highs, it's marked as a BOS. See how there's a series of them one after another? According to this framework, as long as the market keeps creating these upside breaks of structure and it doesn't break the major lows, that bullish trend is still very much alive and well.
And that right there, that's really the key takeaway. This whole system gives you a framework to read the story that the market is telling you. A series of these BOS moves means the current chapter, the trend, is still being written. But that very first CHOH, that's your signal that it might be time to turn the page.
So I'll leave you with this final question to chew on. The entire theory behind this smart money concept is that these huge institutions are moving the market on purpose to hunt for liquidity. In other words, to trigger all the clusters of stop-loss orders that retail traders have set. So if you start to see price action not as just random noise, but as a deliberate process to engineer that liquidity, how does that fundamentally change the way you look at a simple price chart? Thanks for tuning in.